Hello, hello, hello. Uh, we are officially here for the first part of the commercial claims series. My name is Anthony DiUlio. We're going to have some people hopping in now. So I want to make sure that we give them a chance. We've got a ton of people registered for this one. So I'm extremely excited about this. The commercial claims series is an area of the insurance industry that really needs some extra love and attention. There's not a ton of people that do them on a regular basis. I think there's a lot of fear behind them. So we want to put this series together to allow people an opportunity to learn more about commercial claims. So take away a lot of the mystery behind commercial claims. And with this first class, we're going to talk a lot about kind of just understanding that policy, understanding things that are different with commercial claims at a pretty high level. And then in later series, we're going to talk a little more in detail about that. As always, we have the chat that is available on the side. You can type a message into the chat anywhere you need. I'm happy to respond. One of the values of being part of this live is that you can ask those questions as these moments arise versus the people who just watch them later. So please feel free to use it. Would love to hear any questions. It's one of my favorite parts is to get to answer those for people. We're going to try a little bit of a different format because I'm actually down in Virginia right now. For those of you who don't know, I'm pretty actively involved in a bunch of organizations. MAPIA, which is the Mid-Atlantic Public Insurance Adjusters Association, has expanded to Virginia. We've got our first meeting down here today with some of the legislative body, some of the commissioners actually from the Insurance Commission here, who are coming out to talk with adjusters, get to know everybody so that we can all be working towards a goal together to make things better. So let's jump into this so that we're not waiting too long. It seems like there's a ton of people jumping in, so really appreciate it and love seeing you guys here. So you guys don't need to look at my ugly mug the whole time. We're going to try a little bit wider of a format for this series because there's some text that's more important with these than usual. So let me know what you guys think about this. So as we talked about, this is the commercial claims series, and this part one is really about demystifying the commercial policy. They're not as bad as you think. They are complicated, guys. I don't want to make it sound like they're easy. There are more policy forms, more things that you need to understand and go through, more coverages. But in the end, it is something that any adjuster really can do with the right training, the right practice, and the right information. So what you're going to go through today, we're going to go through really what a commercial policy is. We're going to talk about breaking down, reviewing of that commercial insurance policy, and talk about some of the most common differences from those who might be handling residential claims, who deal with roofing and plumbing leaks. What are you going to see as some of the major differences as you are starting to handle these commercial claims? Just to have the slide here, for those of you who don't know who I am, my name is Tony DiUlio. I'm the owner and partner of Wheeler DiUlio and Barnaby. We're a law firm who now gets to practice all over the country. I get to travel helping insureds with these losses. Our home base is out of Philadelphia, Pennsylvania, but really working everywhere. We've got 9 attorneys now, and we're continuing to grow. We've got another one starting in October because we want to make sure that we're in a position that allows us to not have to say no to claims because we're too busy. We want to be able to help as many people as we can. So we're continuing to grow through that process. We focus entirely on property damage litigation. So it's not just first party claims, although that is the vast majority, about 80% of the practice. But we also have claims against insurance agents, contractors, realtors, sellers, really anything involving damage to a property. We've handled those, and we're always happy to help. I have to do these disclaimers. The internet is going nuts right now with conflicts in this industry of people fighting on Facebook and LinkedIn. It's getting crazy. We are an industry that really from all sides should be focusing on what is best for the property owner. That is not just us as lawyers or public adjusters, but also as carriers and third-party adjusting companies and roofers. Everybody should have the same goal, and that's to get the property back to its condition it was and to get whatever coverages are afforded under the policy paid for. We don't need fighting back and forth within our industry to do that, and I'm turning as much towards that path as I possibly can so that we have the right path moving forward. With that being said, I put this disclaimer because I always get nervous of somebody coming in and saying, "Oh, Tony, you went through this class and you didn't tell me that this thing is a possibility." Well, the idea of the disclaimer is to tell you, look, I'm not going to go through everything, so read the policy, and you've got to make sure you understand what you are doing. So, this commercial policy, guys, it can be scary, but it's not as scary as you think. I totally understand that this can be a complicated thing to look at with all those pages, but really it's not that much different than what you have, at least in format, with your standard residential claim. So I actually used this identical slide, at least for information, describing the declaration page for a homeowner's residential claim and used it here. I just added one extra bullet point, but it's really important that you are getting these declaration pages and reviewing them as part of your claim. One of the things that I'm going to repeat over and over and over again is that commercial claims are far more unique when it comes to their policies on a case by case basis. Uh, there are commonalities in residential claims that you're going to see over and over again when it comes to exclusionary language, coverages, and things like that. The policies for commercial claims are extremely specific to not only the industry of the commercial claim, whether it be churches, hotels, warehouses, businesses. They're all specific to those, but they are also very specific to the property itself. And there's going to be way more endorsements under most commercial insurance policies than there will be under a residential policy. And it's because they're adding in extra coverages for things that residences just simply don't need. And we're going to talk about some of them, but like business income coverage, right? That doesn't exist for homeowners for obvious reasons. So that needs to be in there. Cyber coverage for businesses. All of these things create new endorsements, and it can be confusing at first, but when you understand the process and actually read through these endorsements, you'll start to understand them more. You don't need to be afraid of those. But the deck pages is your starting point. It's your guidepost. It's really the most important part of the policy because it sets and dictates the rest of the policy for you. If the forms section of the declaration page doesn't have a particular form that the carrier is trying to reference, it's not part of this policy. You don't get to reference that. But in the same vein, if you're trying to look through the entirety of the policy and you notice that you're missing endorsements that are listed in the form section, you should make an effort to go get those as part of this process. And we're going to look at a few of these, but you're going to see how some declaration pages do a pretty decent job of explaining what the endorsement is through a title. Others just leave you guessing what they are, and you've got to go into the endorsements to find them. And this is one of the things that I think causes a lot of the confusion and fear with commercial claims because you're dealing with endorsements you're not used to, a lot more of them. You really don't even know where to start. It feels like it's a mountain that you're in front of, but it doesn't need to be. Because when you break down these deck pages, you're going to see that it's a lot of the same information in the same format. The named insureds, their mailing addresses, the insured address. And what I added in here is that the property's insured because a lot of commercial policies will cover multiple locations, multiple buildings. You can have that broken down and look through in those declaration pages. But you're going to see the other things that are common, the limits, the forms, which we talked about and are so critical, and of course, the deductible. So let's take a look at a deck page here. This is 2 pages. I've tried to redact the documents as much as I can, but to the extent that they are not, please forgive me. There's no intent to disclose anything, although nothing here is really protected anyway. But this is a declaration page for a commercial insurance policy. And you're going to see a lot of the same stuff that you do, the named insureds, your policy limits. But I want to bring your attention to that forms list in this example, and we're going to look at another one in a moment. But the list of those forms is extensive. right? We've got, I actually didn't count this ahead of time. One, two, three, four, five, six, seven, 10, about 50 different forms that are part of this policy. That's a ton. If you're first time looking at a policy and you see 50 endorsements, you're going to start having your eyes roll in the back of your head and be like, what do I even do with this? But the truth is, a lot of these are going to be for liability coverages. They're going to deal with areas that have nothing to do with the particular claim, but you need to make yourself familiar with it because you don't know if there's going to be some hidden coverage or hidden exclusion within those endorsements. So it's so critical that you get all of those forms when you're reviewing these commercial policies. As a refresher, we've talked about this in other classes that I have done. Those form numbers can be found either on the bottom margin or the top margin of the insurance policy itself. So you can always go through and just check mark, hey, okay, I've got this form CGL YCR 0798, check. And go through and make sure that you have all of them so that you know you're looking at the entirety of the policy and have all of the potential forms. And this is a policy that is a perfect example of you don't know anything by looking at this endorsement list. They give you nothing but the form numbers themselves. And as a result, it gives you no additional information. But not all policies are like that. There are some carriers who will actually outline some of the endorsements and the forms that you can go through so that you have a sense of, okay, is this actually something that I need to look at? Beyond that, we've got a lot of the similar information. This is another example of part of that declaration page that I had just shown. Just did a call out to the descriptions of coverages and the description of optional coverages that are provided under this. It's not that much different from what you're going to see in a homeowner's claim. You're going to see your coverage listed. This as building, business income and extra expense, and business personal property. Conversely, on your residential policy, you'll have your structure, your other structures coverage, personal property, and likely ALE as the four coverages. This just lists them for the ones that you have for the business. So it's not that crazy. You've got your limits of insurance that are listed, your co-insurance penalties, the covered cause of loss, which we're going to take a look at because that is unique in most commercial and business policies, and your deductibles. Also, make sure you take note that the description of optional coverages indicates what it has replacement cost coverage for the building and the building personal property. Again, that can adjust accordingly based off of the policy. So, just know what you're looking at. This policy, rather than just giving you the form numbers, actually lists out what the form number is and then the title of the form. Makes it a little easier to be going through because if you have a claim for water damage from a plumbing leak at your hotel, then you don't need to really worry about the cyber form that might be part of the policy. So you can go through and do a little bit more cherry picking. But I want to caution anybody when they're doing that because you want to err on the side of caution. If a form title doesn't make it crystal clear that this is not a form that is something that you need to be reviewing and going over, then it is absolutely something that you should get and review just in case. I hope I am stressing as much as I need to that you need to read these policies. It is absolutely critical throughout this process. But again, you can see that this commercial form, this one was for a hotel client that we had actually down in Virginia where I am right now. They had an issue with their hotel from a lightning strike that caused a fire and then resulting water damage. They had a number of endorsements. It's not as many as that last form that we had looked at that was for a church, but still a lot of endorsements that need to be reviewed and that you need to go through. At no point will I ever be able to go through all of those forms with you. But if you have questions about that, I'm happy to review them, talk to you about them, whatever you might need to help this process move forward. As always, part of this, you get my contact information on that first slide, my cell phone number, my office, and my email. So whatever I can do to help, please feel free to reach out. So let's dive in a little bit to these forms because going through a commercial form can feel really intimidating. I want to take some of that away by going through it and giving you just a sense. One of the problems with insurance policies in general is the jumping around to try and determine what coverages are even available, right? You get your initial coverage grant within section one, and then it says, but unless it's otherwise excluded, and you've got to go to your exclusions. And using CLAPS as an example, CLAPS is an exclusion under the policy, but then it says, except for the additional coverage of CLAPS, and then you got to go jumping back to the additional coverage for CLAPS. Truth is, commercial policies are no better, and in a lot of ways, they're worse when it comes to jumping around. But it is a flow chart of coverage that you can get used to doing. This is no different than riding a bike, or even like when you first reviewed your first residential policy, they were confusing to you. And I understand that this might be too, but it is something that you will get used to, and you really shouldn't be afraid of handling those claims and helping those people if it is something that you can do. So I want to take a look at the first coverage form that I've got here as an example. And what you will notice, a lot of coverage forms for commercial claims use the ISO forms. If you don't know, ISO is the Insurance Services Office. They actually produce forms for the insurance industry to use as part of their program so that they're not having to draft their own language. It was far more common a decade or so or more ago that homeowners policies would have straight ISO forms. They are not nearly as common anymore. You've got carriers who are writing entirely new policies, like Farmers, and then you've got carriers like Allstate and State Farms who use modified ISO forms, so they're all unique to those carriers. The ISO forms used by most commercial carriers are the actual forms from ISO. So you'll get more used to what those forms are by just recognizing the numbers and saying, "Oh, this is the standard ISO GC policy. We're good to go," or whatever it might be, so that you're not as intimidated moving forward. But this is a standard ISO coverage form, and this is where they provide your initial grant of coverage. So, like most commercial policies, we will pay for direct physical loss or damage to covered property at the premises described in the declaration page caused by or resulting from any covered cause of loss. Okay, that's great. I'm very happy that I've got coverage for direct physical loss, but what is a covered cause of loss? By looking at this and seeing that that phrase is capitalized, I know that that has additional meaning within this policy. Either it's a defined term or it is actually just a separate section under the policy that we need to go locate. That's part of the mystification of this is, well, where do I go? It's not immediately below this line, which would make it super convenient. It's buried deeper in the form. I think it's number 3. We'll see how good my memory is. But what a covered cause of loss is. And you might laugh when you look at this, because you go further down into the policy and you go to number 3 and you say, great, I found covered cause of loss. And then all it tells you is, see the applicable causes of loss form as shown on the declarations. Okay, so I've got my initial grant coverage it's telling me that it's based off of the covered causes of loss. And then I go and find out what covered causes of loss, and it says, go look at the declaration page for the applicable cause of loss form, meaning that this is going to be a separate form, almost like an endorsement to the policy that is being applied. So I go to the declarations page. Fantastic. I'm here. Now, what am I looking at? I take a look, and this is the section that we looked at before, right? It has my building, my business income and extra expense, and my business personal property coverages. So I have to figure out what my covered cause of loss is. And you can see right over here on the right side with my fantastic highlighting that all 3 of these have the word special listed on it. And now a lot of people might hit a wall and say, okay, what does that mean? This isn't telling me what I do with this information, right? The other things told me to go other places, right? To go look under covered cause of loss, to go look in the declaration page. Well, now I've got covered cause of loss special. What does that mean? Well, if you look at the forms, because you've got to remember that prior provision that we looked at, I'll go back just to reiterate. It says, see applicable cause of loss form as shown in the declaration. So we know that the cause of loss is special. We have to go find the cause of loss special form. Well, this makes it real easy because I had it on the next slide here for you. But one of the things you're going to look for is this special form. And this is going to be one of those forms that you get pretty used to. The CP 1030 is a standard commercial policy form, and it comes up all the time. A lot of adjusters who handle this day to day know these forms like the back of their hand because they deal with them over and over again. It's a standard ISO form. So this process that's taking me 5 to 10 minutes to explain to you, because I'm teaching it as if you have no idea what a commercial policy is. And for those of you who do, I'm sorry, this is probably really boring, but uh, you can actually find this within seconds if you know what you're looking for, because most adjusters will just see special on the cover on the deck page and then go right to the special form. But this form now gets us the language that we need. And it says covered causes of loss. When special is shown in the declarations, covered causes of loss means direct physical loss unless the loss is excluded or limited in this policy. So all of that just to come through and find out this is an all risk policy. Fantastic. Uh, but it is critical to understand that I use the term all risk. I know it doesn't say that, but this covered unless otherwise excluded language is different in a commercial form that homeowners, you cannot, I want to stress, cannot make the same assumptions that you might under an HO3 homeowners policy that you would under a commercial policy. There are significant differences contained within those. We're going to talk about some of them today, and I'll dive deeper into those on future webinars. So make sure that you're understanding that there is a difference and you need to review that. All right, so we know that we've gotten to an all risk language. We figured that out. So let's take a look at some of the differences for that these commercial policies have that are different from the standard homeowners policy. I'm stressing it again. I'm going to say this a few times because people jump on and off of these webinars. And of the 50 some that are on this right now, I don't know who was on at the beginning, read the policy. I'm leaving out the F, but read the F in policy. It is so critical when you're doing this. So one of the number one differences in commercial policies that comes up over and over and over again is water damage exclusions to the interior of the property as the result of rain or wind. So when you have a commercial loss, a storm comes by and water gets into your property, most commercial properties, at least that I see, have some version of a flat roofing system. It's not a shingle roof, it's a flat roof. And one of the number one issues that people have that they don't recognize when they first get into this is they say, oh, well, if I'm on a residential loss, even if I don't have wind damage to the roof, often that ensuing water damage from the roof and the rain is covered. That's a no-brainer under most policies. That is not the case under most commercial policies. Most commercial policies contain this language that I want to go over with you. And this is under the exclusionary language under G for water. And it says, we do not cover for water, meaning flood, surface water waves, tides, tidal waves, overflows, or their spray, all whether driven by wind or not. And then it keeps going further. And then we get a limitation under the next column under C. And it's saying there's a limit to the interior of any building or structure or personal property in the building or structure caused by or resulting from rain, snow, sleet, ice, sand, or dust, whether driven by wind or not, unless the building or structure first sustains damage by a covered cause of loss to its roof or walls through which the rain, snow, sleet, ice, sand, or dust enters. The loss or damage is caused by or results from thawing of snow, sleet, ice on the building or structure. So big difference here. You guys might be well aware of this. You might be seeing this for the first time, but it is so important to understand because this gets litigated over and over again. The building in these losses for the interior to be covered from rain that comes in must sustain damage. It's an important word here. Must sustain damage by a covered cause of loss to the roof or walls which the rain, snow, sleet, sand, or dust enters. There's a few aspects here that need to be broken down. First of all, what is damage to the roof or walls? Does damage need to be permanent? By way of example, what if something opens up in the roof, a seam in the flat roof? It opens, the water gets in, and then is in some form or fashion able to reseal. Right? It's a hot summer day. It lands back down, reseals, and you've got no idea. First, you're going to have a hard time finding it, but the harder point is proving it. Because of this shift in coverage and the fact that this is a limitation that adds back coverage if there has been a storm created opening, that burden for the storm created opening is on the insured. It is on the person presenting the damage. So you must be able to show what damage occurred to the roof or walls that allows the water to get in. If you can't make those arguments of, oh, there must have been damage, but we just can't find it, because you've got the burden to actually prove it. Beyond that, then we get into an argument of, okay, well, what constitutes the roof or the walls? I had a commercial claim out in Gettysburg where a roof was damaged. Whether or not the roof it was damaged was a question after another storm damages the roof and a tarp is put over it. So client has a very small leak, doesn't put an insurance claim in, but decides they're going to redo their roof. They tear the roof off. A storm is coming in, so the contractor puts a tarp over the roof, nails it down, does everything they can to secure it. Unfortunately, the storm blows the tarp up, water gets in, and now causes some significant damage. It is way worse than it was the first time. We're now in millions of dollars of water damage to the interior of the property. And the question for the judge was, well, does that constitute a roof? Right? Is the tarp on a roof? And we were successful. It was a great opinion that came down from Judge Beadlestone of the Eastern District. And she ultimately came to the conclusion, based off of depositions and testimony, that the defendant kept saying they rely on all these outside third parties to define what a roof is, some different guides and dictionaries within the industry. And every single one of them said it was the uppermost covering of the property. None of them defined it as needing to have any kind of permanence. So as a result, the tarp on the roof was enough to constitute a roof. And when that blew up as a result of the storm, we've got our storm created opening. Now, I know Bill Underkoffler, he's got William on there, but Bill Underkoffler makes a really important note, and it is worth pointing out. It doesn't say an opening. It just says damage. I'm using the phrase storm created opening because it's something that the industry talks about a lot, but Bill is 100% correct. It does not require it to be an opening. It just requires damage. So if you have an opportunity to make an argument that there is damage that then allows the water, sleet, or sand to enter through the roof or the walls, absolutely you can make that argument. So, and that gets us to another critical aspect of this, and this is a claim that I actually had with one of Bill's adjusters, where a commercial property had a blockage as a result of a storm to the drain on the roof. There was some debris that came down from trees and leaves. It was a pretty bad storm that blocks the drain, and water starts to fill up on the roof. This, again, is a flat roofing system. Water's got nowhere to go, so it literally is creating a pool. And as a result of that, water pours over an AC unit that has an opening in it and pours into the property. And there was an argument that from the defense, from the carrier, saying, look, the water didn't enter through a damaged area of the property, therefore there is no coverage for it. And at first glance, honestly, even when I first looked at it, I was like, they might be right. But I started to really sit and think about this, and we realized that the policy language doesn't require that the damage be the area that allows the water to enter. So the damage to the roof was the clogged and blocked drain, and I think this is probably what Bill was getting at. That was the damage to the roof, and that allowed the water to enter through the roof or walls of the property, getting into the property. That met all of the conditions necessary under this provision, and as a result, we still had coverage available from that loss. So it makes a really big difference when you really dive into the language of these policies and understanding what are the tying factors? What are the relational factors between the damage to a covered first sustains damage by a covered cause of loss, a block drain that was to its roof, covered or check, which the rain, snow, sleet, ice, or sand enters. It entered through that roof. Great, I've got coverage. So breaking that down and having that understanding can really make a difference in getting the right result for your clients and making sure that those carriers are paying for what they're supposed to be paying for. Uh, if you guys have any questions about these, let me know. But it's really important that this is understood because it's a really common claim within this industry, which is why I'm spending so much time on it. The other part of this is important for number two. The loss or damage is caused by or results from thawing of snow, sleet, or ice on the building or structure. Because of the or that ends number one, you don't need to have the damage to the roof as a result of melting or thawing of snow, sleet, or ice. Excuse me. So that's a really important distinction because a lot of people get it in their heads that they need, and again, I keep using the phrase storm created opening, but you need damage first, and then you need the water enters causing the damage. That is not the case with snow, sleet, or ice. So if you have snow on a roof or sleet on a roof or ice on your roof, and that melts and that allows the water to get in, that is a covered claim. Most common example, at least that I can think of, you've got your flat roofing system in the middle of the winter, you've got a really bad snowstorm that comes through. The snow starts to melt, and everyone knows that there's those seams on the roof where the rolled roofing gets put down. And maybe some of that water got underneath, but not all the way, just a little bit through an opening somewhere. And then it freezes again. And now that opening is created a little bit more, but nothing too bad. And at some point, it ultimately melts, and you've got an opening, not from anything that might be otherwise covered, although this arguably would be, but you've got an opening that allows that melting ice in. Now you've got coverage. But here's the trick. Even if you've got those openings just from some other aspect of the roof, it's old, the contractor didn't put it on, something else happens, and that water gets in, not from a covered cause of loss, you've still got the coverage under this because it's from the melting of the snow, sleet, or ice on the building structure. So you've got to recognize that you have these different avenues to coverage for different situations of different losses. Again, the way you find this out is by reading the policy. So make sure that you're going through and understanding and reading the policy accordingly. All right, let's keep diving through to some of these other sections that come up most commonly, so that we can get through the questions that everyone sent over. Some of them were pretty good ones. Business income and extra expense. I'm going to do an entire session on business income and extra expense coverage. It can be complicated, but it doesn't need to be. People overthink this often. It really doesn't need to be an issue. But here's the thing I wanted to point out. First of all, the coverage exists. If you didn't know that, now you do. But more importantly, the conflict that comes up so often with these claims is between the income that a business is bringing in versus their actual net income or net profits after the expenses are accounted for. You don't get to just say, oh, I brought in $1 million in revenue net last month. Insurance company, give me $1 million. Because most of the time, there are expenses that the business doesn't have that are the result of a loss. So, for example, hotel claim, hotel burns to the ground, or has a loss that shuts down the hotel. You don't have to pay things like housekeeping anymore. You don't have your staff. You might still have things like internet and other expenses, but you've got to be able to reconcile the cost savings that you have as a result on one hand, and the revenues and income that you have on the other. So it's not enough just to say, I've had this much money come in, give me that much. Another aspect that can get pretty difficult in a lot of claims is that a lot of companies, for tax purposes, want to show as little profit as possible. Well, that's fantastic for tax purposes, but not fantastic for insurance claims. So you want to make sure that you're working with a professional that can reconcile that appropriately to deal with that. The last piece of this puzzle that is difficult for clients to kind of wrap their heads around are the income for the person individually versus for the company itself. So if you're in a situation where you as a person were normally making X amount of income as a result of the company, if the company's showing that as an expense, and that expense is not a necessary expense after the loss, you're going to have some difficulties there. So you want to make sure that it is presented accordingly, that the salaries to continue the business running, to continue even with the insurance claim, might be salaries that need to continue to be incurred, so that they aren't just deducted as an expense that is being saved as the result of the loss. Again, I'm going to do a whole hour on this on one of the lunch and learns, so please feel free to join in that one. It'll be one I think worthwhile. Another really big aspect of commercial claims are protective safeguards. In layman's terms, protective safeguards are things that an insured is required to do to continue to maintain coverage for their property. Sometimes those protective safeguards can be limited in the coverages that they affect. Other times they can affect the policy as a whole. So if you have a protective safeguard for, by way of example, to have a particular number of fire extinguishers on your property, that protective safeguard, while related to fires, may or may not only affect fires. What I mean by that is your protective safeguard could say you're avoiding a lot more than just your fire coverage by not having those fire extinguishers on the property. So you want to make sure you and your clients are aware of what those protective safeguards are, so that they've been maintained as part of the loss. There's a question here from Kirk. How do you handle projections if a business is new and doesn't have a prior year or prior years to show income and income trends? Awesome question, Kirk. I'll give the short answer, but again, I'll go over this in more detail. What you do is to have comps from other businesses. I keep referring to hotels. We do a lot of hotel work. So you can actually get what reports within the hotel industry to see what other hotels are doing in the area and their amount of business. If it is a business, a brand new business that you've just started, you're going to want to try and find other comps within the industry. Get an expert that is involved in that industry. Get somebody like that to come in and say what the projections are. If you've purchased the building, purchased the business, and maybe that prior business owner gave you records from the prior years, you could use those. But generally speaking, you're going to want to get comps from those other areas or an expert involved that can help with those projections. Truth is, a lot of times a lot of it can be conjecture, but that's why you get an expert involved to at least give you the best foot forward. Caused a really big problem during COVID, because with the shutdowns, insurance companies, when the loss occurred, said, well, you weren't going to be making any money anyway. And they really had quite a bit of battles when you had an insured loss during COVID as to what those numbers should be, because it threw everything off. But in the end, there's always some way that you can come up with a decent number. And then Bill had made a comment, a tennis ball in the roof drain can be, quote, vandalism, as a kid could have tossed it up there and the ensuing water would be covered. Sure. That's, I think, one of his examples of other damage to a roof that could be, but definitely an interesting take on that one. So back to the protective safeguards. With these protective safeguards, they are requirements under the policy. They are unique to the particular property and the particular risk, and it's something that happens during underwriting when the policy is being written as to what needs to happen to make sure that these protections are maintained. It can cause a real problem when these protective safeguards are not taken care of. So make sure that your insureds understand that risk and have the evidence they need to show that the protective safeguards were maintained. For those of you who deal with residential claims on a regular basis, think of a protective safeguard like the requirement to maintain heat for a frozen pipe claim. You have a frozen pipe. One of the requirements, if the property was vacant or unoccupied, is to show that the heat was maintained in that property. So protective safeguards act very similarly to that. It is on the insured to show that the protective safeguard was in fact maintained. So again, make sure your clients have a good understanding of that. All right. This one is, I'm actually having a harder time reading this one. I apologize. It was so small on my screen, I couldn't even see what it was. I'm really getting on. Oh, this is more of the extra income. I don't know why it's out of order. This is another form for the extra income and business expense coverage. We've talked about that plenty. We don't need to spend more time on this. This is the standard ISO form that you will see for business income and extra expense coverage. So just know that is one that you'll get pretty used to. All right. I've shortened this one up a little because I'm about to present for MAPIA and the Virginia Insurance Commission at 1 o'clock, but I never want to ignore the questions from the emails when you guys register. They're important to me, and I always make a promise that I'm going to address them. So I wanted to make sure we saved time for that. First question: will commercial policy cover loss of quote goodwill? This was an interesting question and one that I needed to look into a little bit. And I honestly, even with looking into it, didn't have the greatest of answers. But the truth is that it seems like the answer is no. Um, but the loss of goodwill will usually result in the loss of income. So it's not that you're getting paid for your goodwill, you're getting paid for the loss of income. If, for example, your business shuts down for 8 months and you've lost 80% of your customers because they've gone somewhere else, you could argue that you've lost goodwill as a result of that, but that loss of goodwill results in a loss of income. The other aspect of this is that these insurance policies, they make arguments that the goodwill isn't something that can be measured. It's not in no way something that they could compensate for. But in the end, if you can tie it to a loss of income, that's going to be your best avenue for any quote unquote goodwill argument. How different are the commercial and residential policies? Again, we've only just hit the tip of the iceberg of this series of the differences, but the differences are significant. While there are similar exclusions that occur in a commercial policy, you're going to see the same things for flood and other aspects of a exclusionary language in residential policies. It's the endorsements that really change the game. They're so unique to a commercial policy, and they change so many aspects of it that it makes it really important for you to understand and go through those. John just had a question. I haven't done these in so long, I forgot about this function, so I'm going to pop it up here. Working with a franchise that suffered water damage, the current layout is not available, and they need to upgrade to the new configuration. Are the additional costs covered? That is a great question, John. First and foremost, I'll tell you what I tell everybody: read the policy because it will be dependent on what is in there. However, to the extent that the repairs anything that should otherwise be paid for under the policy aren't physically possible, it's no different than changing from asbestos tile to ceramic tile, or needing to make changes to the roof to comply with the current, not even, I don't want to say complying with code, but just the way roofs are being built now. You're not going to go back and have a base of cedar shake as your underlayment and then put a roof over top of it. So those changes can still be accounted for. You just need to be able to show the carrier that this is the best available option for what the needs are. And I think you've got an argument there that the upgraded layout would be something that could be covered. All right, let me make sure I get back in here so I can click through these. Recoverable depreciation is getting almost impossible to recover on commercial claims regarding the holdback money. What are the parameters that govern what limitations the carrier demands before they release holdback money? So this is a great question, and one that is coming up more and more often, because there is this balance between the business owner's desire to really spend as little as possible for an expense purpose and the making the repairs to the property. The truth is, though, that the parameters of the release are not that much different in a lot of commercial policies as it is in a residential policy. You've still got to show that the dollars are being spent, the repairs are being made, and that they aren't going to be upgrading or otherwise changing the property as a result. So I don't know I don't even know whose question this was, but what the particular issue is, you want to make sure you are documenting really well all of those expenses to make sure that it gets released. Kirk had another question here. Are PA fees an extra expense if not otherwise excluded or partially excluded as they relate to the ISO endorsement for inventory and appraisal expenses? So I've been trying for a couple of years now to make some changes to how PA fees are getting paid and whether or not we can make the carriers ultimately pay for those. My argument has always been on claims that, for example, involve additional living expenses. A carrier will pay for a third party company to go find housing. I don't really see much of a difference when it comes to using a third party company like a public adjuster to do an inventory or an appraisal of a loss. Now, appraisals are governed a little bit differently because they have the actual language within the policy regarding who pays for appraisal expenses. But inventory expenses could be an item that could be paid by the carrier. What I would recommend is separating it out outside of the contingency fee agreement that most public adjusters work under and charging an hourly rate for the work just as any other third party would be doing and presenting that as part of the loss. I know a few companies that work with kind of a sister company, if you will, that does just inventory work. So it's under a different name. The work is done by a different person and then charged accordingly to the carrier. And I have had carriers that have agreed to make those payments. So the difficulty becomes if you're doing it on a contingency fee is where the line seems to be for me and well, for the carriers, I should say, for getting those paid. If you're charging it as a contingency fee, most carriers, in fact, I've never seen a carrier agree to pay those, but they have paid for the hourly work on those. All right. I think there is two more questions here. And of course, keep the questions coming from you guys. Okay. The newer wrinkle post-COVID is the owners of commercial property are considering conversion to rental units. This might come up after a loss in a damaged area where the business is no longer viable. How does that work in settling a commercial claim? Excuse me. The truth is if you are converting to something else, this is going to limit your recovery because you're not going to be able to get that replacement cost value for the property. The viability of a business is not the problem of the insurance company. If you decide, hey, it's just not making enough money, I want to go back with condos, great, you're welcome to do that, but you're only going to get that actual cash value payment, and you're not going to be able to recover the replacement cost and the depreciation. Kirk added, I'm referring to appraisal of value of items, not the appraisal condition of the policy. Fair enough, Kirk. And in those situations, again, to the extent that that is being charged on an hourly rate from a third party, that even if it's a sister company of your firm, I have seen carriers pay for those. The question really comes down to that negotiation with the carrier. Some of them are going to continue to push back, but we've had success litigating those when that does come up. How to make insurance companies pay by their own policy rules. What do you do when they add extra contractual requirements? So, guys, this is kind of the entire job of the public adjuster. How do you hold them accountable under their own policy? What I will tell you is using their own policy language is really the key if you're having policy fights, right, over contractual obligations. What do I have to do and not do? Address that with them so that you can say, hey, look, carrier, you're saying I have to do X, Y, and Z. Do you mind just pointing me to the policy language that allows you to do that? Sometimes they can, sometimes they can't. And when they can't, the backup for them are things like, oh, we'll cooperate in the investigation. Well, that means you have to do X, Y, and Z. And the question becomes, where's the line? There's no bright line answer to this. There are opportunities for you to report claims to insurance departments to get them involved. You can obviously speak to an attorney, which often becomes the final last step that you can take. But there is no magic bullet. There's no one letter that you can send or one piece of advice I can give you other than keep trying to get better at this as an industry. Do all you can to be the best adjuster that you can. So, ladies and gentlemen, those are all of the questions. I really enjoyed doing these. I hope you guys continue to get value out of them and these discussions, particularly with the back and forth of questions. I always love to have it. I'd love to hear from you as to what other courses you want to know or have presented to you guys, because that's the value that I'm trying to add. I do them for free because I want this industry to be as great as possible. And I want to thank all of you for your time and what you guys do as an industry for the uh, the country as a whole. It's really incredible, and it wouldn't exist or work without you. So thank you so much, and everybody have a great day and great weekend.